So today's topic, we're going to review supply and demand. I got this little article, walkthrough. We'll visit, and then we'll look at a couple of examples on the chart. So part of this article, we're going to discuss pointers which are related to supply and demand zone trading. I think it's one of the simplest yet powerful, simple yet effective strategy or way you can actually view market structure. So the things we're going to actually cover is structure of the market, what is supply and demand zones, how to find supply and demand zones, different types of zones, how to measure the strength of a zone, when did the supply and demand zone break, how to trade with supply and demand zones, and then odd enhancers for trading with supply and demand zone. So first though, we got the structure of the market. And if anybody got any questions, need me to point anything out, just chime in. But the price goes through the following phases. We're going to have accumulation, reaccumulation, uptrend, distribution, or redistribution, in a downtrend. So these are different phases that we like to identify in the market. They're going to be kind of like our yellow flags, getting us ready to facilitate or participate in trade. So we can see from this little figure here, or from this little diagram, we got accumulation down at the bottom. We want to get to the mindset where we're buying at the lows, selling at the highs. So we see accumulation. You're going to notice a channel, or you'll just see price kind of consolidating. Then we get the break up or the trend up. Sometimes you get a little pullback through it. We'll come into a supply zone. Generally, this is going to be a previous supply zone that we can find throughout history. Price does move in a range. So if we start right, look left, a lot of times we can identify these strong or key areas. Then we come into distribution. Distribution will drop the price down. We got sellers coming in, and we also got people that were buyers or bulls taking profit, which is turning them into selling orders as well, which give us a little bit of a retrace. At that point, we probably will stable out or start to reaccumulate at a previous zone. We can see where we pull back here, giving us some good key support. We reaccumulate. You also maybe notice some patterns that have come into play. Things like it's a triple bottom there, W formation. We shoot back off up to the races. So it's going to be a little example, a little diagram for you guys. I'll post all this into the group. Now, accumulation of smart money is removing the floating supply of the stocks or currencies by buying. This process is called accumulation. If you guys flip through the how institutions trade, they'll give you a more defined look at how the actual buying program is done. They'll put in 10,000 contracts, and they're trying to get their full size in without actually moving the market. Now, trend up is smart money aggressively moving price up. Distribution will be smart money taking advantage of the higher prices obtained in a rally to, again, take profits. Excuse me, by beginning to sell the stock back to uninformed traders or investors. The law of supply and demand. In the market, we're going to start speaking about a lot of different laws, especially when we get into Wyckofian logic. So in the law of supply and demand, all financial markets work on supply and demand. All financial markets work on the universal law of supply and demand. The law of demand is the higher the price of an item, the fewer the demand or buyers don't want to buy at higher prices. So again, we don't want to buy when it's high. We want to, sell when it's up, buy when it's low. Now, the lower prices, the higher demand, the buyers want to buy at a lower price. The law of supply, the higher the price, the higher the supply, sellers want to sell at a high price. They want to get more money, more bang for their buck. And at a lower price, lower the supply, sellers don't want to supply at a lower price. So they don't want to give discounts. They don't want to sell it cheap. What are supply and demand zones? Supply and demand is nothing but the border area of a support and resistance zone. So you may have or may haven't heard me say that, supply or support and resistance, where a lot of people get mixed up with support and resistance, is not just a line, it's more of an area. As we look in that area, we can actually identify supply zones. Typically, I like to look at it with a big candle break. So coming off of that zone, we usually see to break that supply or to break that support or resistance, we'll see a nice, huge candle break. So here's another little diagram. You see where they mark out the supply levels. We have supply zones. You even have demand zones down here, and then you have areas where supply will turn into a demand zone or a break, a retest. Again, to identify, we like to look at these big candle breaks. Then we can get confirmation that it is a true supply zone, which generally it should hold coming back into that level for a retest, or demand buyers, bulls taking profit or selling back to uninformed traders to take profit. Now in this chart above, you'll see the demand zone, supply zone. What we want to find at these price zones where supply overwhelms demand and where demand overwhelms supply. The former is known as supply zones. When the market bumps into supply zones, the price will drop. Then you can make money by shorting the market. Again, let me read that again. The former is known as supply zones. When the market bumps into supply zones, the price will drop. Then you can make money by shorting the market. So I'll try to break that down and explain it in a second. The latter is market demand zones with support of demand. The price will rise, then you can profit in a long position. If supply zone is broken, it becomes a demand zone. Pullback tests from demand zones, you can go long. So it'll be this area here where price was broken, pullback retest. This will be our entry area for a long. Now, how to find supply and demand zones? 2 steps in order to identify the supply and demand zones. Look at the chart and try to spot large successive candles. It is important that price moves a lot. Establish the base, usually a sideways price area from which price started the quick move. So it's a prime, pretty good example here. We see the demand zone, price touching, bouncing, huge shoot, move upward, continuation moving up. So we can identify that as a zone. Or excuse me, we can identify this bottom where the move originated as a demand zone. Now, different types of supply and demand formations. It's kind of in the areas of market structure. Now, there are different supply and demand zones. Some are more popular. Popular ones are shown below. Some of the more popular ones are shown below. Trend continuous base. So we're going to start identifying these as RBR, or rally base rallies, down base down. Now that's for continuations. For trend reversal, it's going to be rally base drop, down base rally. Again, trend continuations will be rally base rally, down base down, or drop base drop would be for the downside of continuation. For reversal, you're going to actually see a rally, a base, a drop, and that's going to show the reversal to the upside. Now down base, then a rally is going to be for the supply or the move downward. We also have something we call flip zone, and I'll show that when we look at some of these diagrams. So here is an example of DBD, or a drop base drop. So you'll have the initial drop, price kind of consolidate, you'll get another extension lower. Price generally likes to come back up and retest that, giving us an entry, drop lower. One thing that we can identify to give us some confirmations or confluence is looking at volume. When we drop, we'll see increase in volume, signifying that the operator or the big players like that move. So any direction, if you're moving up or moving down, you want to see increasing volume. When we start consolidating or ranging, you're generally going to see a low volume. When we start back dropping again, you'll see the increase in volume. And then to confirm that buyers are that this is primarily going to be sellers actually buying to get out of their sell positions, we want to see lower volume. There's not as much interest on the move up. Once we get back to that zone, sometimes price doesn't come all the way up. You'll get like a wick or a pin bar, giving us another signal to get in. But what we want to see is we're going to start seeing, after our entry, we want to start seeing volume increase, confirming that move is indeed a true move or an extension stitching lower. Same thing on the bull case. You're going to have a rally up, base, rally, pull back right to that previous demand zone. Again, remember, you usually see big candles breaking through this actual zone. Retest, gonna have some type of candlesticks here, like mainly should be wicks, some type of formation. We'll go to the upside, same thing on the volume. So with reversals, what we want to see is prices going to be traveling up or in a rally. We'll see it kind of consolidate, throw out some kind of patterns. Could be just a single candlesticks, depending on our single candlestick for the entry, but the pattern could be a range of things. It could be could be stuck in that zone, or we could see something like head and shoulders form. We could see a Quasimodo, just different patterns, structured patterns, identifying that we just get ready for the reversal. Now, depending on how you want to play it, sometimes we can be more aggressive traders, taking it off this top, just depending on where we're at in the trade, and we'll define it a little later in later sections. But for now, the most conservative entry is going to be to wait for it to drop from that level, pull back, confirm the supply, and then get back into the market or the market to drop. See, again, I'm not going to go over the bullish case, but the same thing, drop down, about base, then we're off to the races. So this is the flip zone. Flip zone is going to be pull up this. There's a pattern called Quasimodo, shows this hump. You may also look at it as a head and shoulders, but you'll get price come up to a demand zone. We'll break above it. We'll come back into the supply zone, but instead of bouncing, you'll see price starting to consolidate a little bit more, then drop. Come back, retest. Still going to be your best entry after it breaks, because the previous demand zone, if it breaks below, generally becomes a supply zone. So now demand becomes supply. So you see a drop, wait for your pullback again. There's your entry. Now, they got a good little example of putting it all together. So you got the rally, you started getting a little base. Now this is a good viewpoint because it allows you to see that it's not going to always be, let's see if I can zoom in on this. It's not always going to be an exact consolidation. We could have like a peak, and then you have those candlestick formations showing you, the price is reversing from this level. So you get the rally, you get a short visit into the actual supply zone, we drop from it, we pull back, there's our entry, and you can see how extreme the candles kind of shoot off from that zone. So this would be initial selling program. They may put 30,000 contracts here, pull back. Let's say even at these little levels here, 10,000, 10,000, 10,000 here. We get up here, here's the big entry, 60,000 contracts, price reacts, drops nice. You get the drop, you get a little bit of pullback, or you start the base again. You have a 3-stick candlestick pattern. So you'll go from green, red, red, showing a pivot, green, red, red, or you will have red, green, green. That shows a turn or a pivot in the market, and we get another drop. Now we're starting to consolidate again, giving us another pattern, double bottom, get the huge move up. For some reason, they gave us they're even shorting they shorted coming back into this base, this supply zone. So until the market confirmed that this was going to break higher, they still played they played to the left. They were looking to the right, seeing to the left that there was a base here before. So they sold all the way back down to where the previous supply, or where we broke supply to demand. Now, then you have a flip zone. So we came down, we flipped. Now this supply, it was previously supplied. We see here to the left, came up, rejected. Another supply came up, rejected. So this was a supply zone, came up, rejected. Then we broke with heavy demand. So when we came back and retested, this supply zone flipped, became a flip zone, and we were off to the races. Nice move, demand coming into the market. So next portion here, and so far everybody with me, man. Drop something in the chat. Everybody with me, man. If anybody need me to
follow.
Cool. So strength of supply and demand zones. How did price leave the level? So it's always important how extreme the move come after we identified that supply zone, or we seen the consolidation. Now the logic, the stronger the price moves away from the zone, the more out of balance supply and demands are at that zone. A heavy order is placed by smart money, or you have that big amount of contracts. They're moving a lot of money at that zone. So strongest, of course, is going to be price gap down from zone and strongly moving down. Strong will be price moving down with big candles with small retraces. So the pullbacks are going to be always smaller. If you look at a Fibonacci ratio, you see 38, nothing above 50, 23, 38, smaller retraces on the way down. So that'll confirm this was a strong move. This is a strong supply zone. Chances is price comes back, that supply zone is going to hold. Now weak is when price doesn't move much. So if you see price comes up, you get into an entry, but you see price barely teetering around, it's going to be an indication that price may get ready to break that zone, move your stop, or go ahead and take profit on that trade. Now, how much time did price spend at that zone? Time at the level. So time over price. One thing you guys could jot down or always remember is the longer price stays well, let me go through this first, because there's a situation where if price stays in consolidation, generally the longer the time price stays in consolidation, the more extreme the move. But looking at this example, the quicker that price moves from the supply zone, the more extreme the move. So don't confuse the two. We're going to be using both premises or theories to kind of time and see how aggressive the move is going to move. But if price comes up to let's say this is a supply zone, and you get this pin bar, a big huge signal, we get a pin bar, and price starts moving, or price doesn't spend much time in that supply zone, that's indications that move should follow through and continue down a bit. This is an example of a strong. Weak is price just kind of staying in the supply zone before it moves. So the less time price spends at a level, the stronger the level. Now, how far did price move away from the zone before returning back to the zone? Now the logic, the further price moves away from the zone before returning to the zone, the greater the risk, the reward, or risk to reward the probability. So higher probability trades are going to be the ones that move further before they even come back to test that. And when price comes back to the supply level for our short entry, we have a good idea where the buyers are, aka the demand, and just as importantly, where they are not. So we get a good idea that buyers are going to be down here where they flip the market. We get an idea of where buyers are. So when we see that supply zone, we get a big extreme move down. We want to stay patient. We're going to always wait for the confirmation or for price to come back and retest. That's going to be our entry. So the further it goes down, we're not worried about missing that move. This is going to identify where are the potential buyers. So we'll know how far or how big of a risk to reward. And it does give us a higher probability to trade the further it went. We're almost finished here. A couple more slides or pages. Now, how many times is price approaching the zone? Freshness of the base. Now, price can hit these supply zones as we've seen in the example earlier, multiple times and then fall, multiple times and then fall. Now, the first time stock retraces, the base is the strongest to enter. We hit it again, price starts falling, it's going to be weaker, 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 or you start getting higher lows, lower highs, higher lows, lower highs. Every time a price is approaching the supply zone, it removes supply from the zone and weakens the zone. So every time it comes up here, you're removing more sellers. Now, when supply and demand breaks after a zone is tested many times or during a strong move, supply and demand levels eventually break due to the remaining orders being triggered, or again, where they're initially 60,000 contracts. Now they're putting in limit orders. Another 10,000 drops it. Another 30,000 drops it. Another 10,000 drops it. Okay, when it gets up here, eventually all of those sellers that wanted to sell and participate in this move or downside action has been taken out the market. Or it can be an overwhelming amount of orders in the opposite direction, breaking that level. Now, price action, if the price stays near the zone, it doesn't fall much, then there's a high probability that the zone will break. Again, we see the weak move down, possibility that's going to break. Strong move to the zone may break the zone, so we get increasing volatility, increasing momentum coming up to the zone. We want to see big candles, then we know they can break big candles, big volume. Low volume tests to confirm the zone. So we always want, in this situation, we want a low volume test. So when price is coming back up, we don't want to see volume increasing on the move to test, let's say the supply zone, or on the move to come back down and test the demand zone. This is going to be just entry. So much more we got. So find the supply and demand zone. We're always going to use the higher time frames, then wait for price to come to this level 2 or at this level. See any acceptance or rejection from the zone on the trading time frame. Any reversal, price action, or signal on the trading time frame, entry in the direction of the dominant trend. Suppose context, downtrend, price rally to the supply zone on trading time frame, then any bearish reversal, price action signal for a short entry. Also notice the volume on these reversals. Low volume test is a good sign that they're highly probable trades. Let's go ahead. We got a couple of examples almost finished. For day trading, previous days highs and previous days low is the supply and demand zone. Look for price action around there for acceptance or rejection of the zone. So targeting, say we come in for Japan Asian session, generally the previous day high, previous day low. It's going to be the range that the price plays into. Those are going to be good supply and demand zones. Either we're going to bounce from there or we're going to break, head lower. We'll get a retest, then we'll shoot down, create a new low or an impulsive move lower. In the hourly time frame, we find the zones. I prefer the 4 hour or even the daily is a stronger zone. We use like the 4 hour. Whether the trend is up or down determines what side we want to be on. Where the big picture supporting demand levels. We don't want too long below the supply zone. Excuse me, not to sneeze. We want to see signs of strength, price action for confirmation of the zone, momentum loss, decreasing candle range, or in body, lower wick, mix of both red and green candles. So here's an example. So we had price come up, got kind of strong, not the strongest, but a kind of strong move down. We bounced up, came down, pretty strong move, but then we started noticing price tries to break it but failed. We see the huge wicks. It was basically a fake out by smart money, or they started buying into this downside move, start pushing up. Price comes back down. Then we start getting a demand zone. Price spending time here, but unable to close below the demand zone. Why do you think? From perspective of smart money. And we can go ahead and see what happens. Price pushes up into that supply zone. So this could be a higher time frame perspective here. And then we have the trading, the TTF, the trading time frame. So we'll zoom in. We'll see how price kind of looks. So you have a previous day. And we can use this to start off for people that's newer with supply and demand. We'll start off with the previous day's high and the previous day's low. There are a couple of indicators we can put on the chart. And that's probably going to be our homework assignment. We'll either use the previous day high, low, or you can, freestyle, and we'll look up some supply and demand zones. So we got the previous day high, previous day low. The black area shows rejections of VWAP. We'll speak about that later. VWAP is kind of debatable in Forex. Now, second entry here, low volume, price action, breakout. So we don't want to take that breakout because it was low volume. Now, sideways price action breakout trigger from demand zone, also previous day's high. So got the previous day's high here, get a little bit of bounce, got that wick there, start getting increasing volume on the move up. So it's going to be looking like a great setup or entry. So this would be an example of a setup. Straight all price action or no real indicators except for volume, just a price action setup. Find your demand, got the pullback, see the wick, move up, see the increase of volume. You can also, we could be using the EMA. Price gets above EMA, breaks above the previous level, we're in the trade. Last couple things here is the entries for candlesticks. We like pin bars, speak a lot about that. Fan of pin bar candles, it gives us clear signals. Engulfings, and then outside candles. Now we're gonna trade with the trend for odds enhancers, and if the index of sector shows positive, then go long from the demand zone. So this is with the corresponding or generally the correlated in either index or sector. This is, we can use this in the way we trade. We can use this in Forex as well, with understanding risk on and risk off. Now, if we were trading stocks, then we want to identify, does this particular stock we're trading belong to the XPX 500, the NASDAQ? If the NASDAQ is trending up, then we want to look for buy trades, because generally it's going to follow the index. Or if we look even at the sector, so we may be trading something in the tech sector, we may be trading Google. Forex, we may see the NAS to XPX is going up, and we're looking at ADI. Now, it does depend on what we're pairing, because in Forex we do have pairs, but if the dollars in that equation as well, but if dollars ranging are getting weaker, then of course we want to go with what the sector index is showing. So it's pretty much supply and demand. I'm gonna jump in here and we're gonna look at a couple of charts. We'll identify some supply and demand. And we'll switch over to the next thing. We'll be done. While I'm marking these up, anybody got any questions on over supply and demand? Thing we covered today.
I have a question, cuz.
Okay.
On your supply and demand, do you use engulfings? Like I know some people will look at volume and then they'll look at like an engulfing candle as their supply and demand. You get what I'm saying?
I use that as a confirmation for it. So if I see it,
Okay.
I think you chimed in, came in a few minutes after. I'm gonna pull it back up. I use it as just a confirmation that it's moving away from that supply. So like, what was it? We always want to see, when we move away, we always want to see a big candle. So that generally is going to be an engulfing. Down here somewhere. Yeah, so we look at it, we just want to spot successive large candles. It's important that price moves a lot. So that's just basically going to be like my golfing coming out of the supply zone.
Okay, cool.
So I mean, even there's one right there. So the drop, the pullback, retest, and then you get the engulfing. That's going to be your, we really enter off of there, and you see. So it just depends on which way if you want to be more conservative, you can let this candle start filling, maybe even come down. If you're looking at an hour, go down to the 30 minutes, you'll probably see engulfings coming in. But we can really enter just as soon as it touches and rejects from the supply zone. So we don't have to really wait for the engulfing, but being more conservative, you'll wait for the engulfing. And it's, I wouldn't say more high probability, but it's a more confirmed move.
That makes sense.
So here we have Euro GBP, which switched to a couple of pairs, just identify. I have you guys tonight, everybody draw me up at least 2 or 3 charts, identifying supply and demand. It'll be our homework assignment, but it's going to be, everybody do it. It'll be kind of vital, because when we jump in the volume profile, the volume spread analysis, some of these concepts of accumulation, distribution, we'll be visiting some of these topics again. So we got the supply zone, and we can even draw this, clear this up a little bit. So we can say even here. So it's really 2 areas that I'll be looking at. See one here as well. So we have the initial move down. There's the engulfer Tim was just talking about. Pullback retest. Could have took it from there. But we got another pullback, came up deeper into the zone. and that would be our entry. So we really had two entries. Got an entry there, then an entry there. The style that I trade is using smaller lots, so I would have took the entry here and then pull back as long as it didn't get too deep. Sometimes you have to give a little. And that was a topic I was going to talk about. Is I posted, we were speaking about the turtle traders. So the turtle traders were a group of a few traders that were trained by a hedge fund manager that felt like he could teach like everyday normal people how to trade. So they ended up like taking, I think, $1 million or 2 million, and turned it into like 170 some $1 million in a couple of years by following systematic processes and using kind of a trend following system. So I say that because one of their biggest things they said in that interview was getting used to profit getting took away from them, from staying in the trade for days, then profit looked like they didn't get any profit. That's going to be something that you guys have to get familiar with. Is sometimes you got to let go of the little fish to catch the big fish. So you can see here, it looks like price even came a little bit and put me in drawdown, but it didn't. It most likely didn't hit my stop, which was going to be above the engulfing. A lot of times we get we get wore out by the market. So it's kind of designed to make us tired, wear us out. We stay resolved, stop looking at the money, monetary, maybe manage or monitor percentages, pips over dollar signs. It's a little easier on the psyche, but you do have to give up sometimes some of these moves to catch these nice extensions. So instead of trying to time it when I'm gonna get out, measure it, or I'm gonna just take 50 pips, I'm gonna let these things run until they tell me that they either hit my target or they tell me through market structure it's time to get out. So price came back up. I would have set another entry, another engulfing. This time we extended more. So it's like the charts or the market rewards you for being patient. So at this point, I'm two entries deep. I may go ahead and skim a little bit off the top when I see this reversing. I might take off one entry, take off partials. You guys may see me take partials. Let price come back up, see what it does at this zone. Third time, it gives me another bearish signal with the candlestick. It gives me a doji right at the zone, taking it again. This time I have profit, I bank profit. So now I don't use set lot sizes. I use what we call variable. Now that I made money, I'm going to probably risk it all, put it all on black. I probably double up my lot size. Wow, I'm rewarded again. Now maybe take off half, or if I feel like letting the whole thing roll, pulls back. This time it doesn't, it stops early. It's another sign. I mean, I could go ahead and take it again. And we are looking at the daily chart. So this is, pretty extreme example of holding, but you can imagine if we were at the hour or the 4 hour, it'd be the same concept. There was another 3 days of rolls, and that's, quick 100, 200 pips. Let's see from where we first got our entry at. So we got our entry somewhere right here where we ended. So about 285 pips with about 3 entries each one. We probably got about 100 pips. So we probably changed this 285 pips. Trading that way, we probably get about 400, 500 pips out the market. So one more time, I won't spend so much time looking over it, but we'll look at another supply. So here's one I already have marked up. Supply zone here, almost the same exact setup we had before. Price came in, or price dropped, retest, that was our entry. And this even had more of a high probable trade. We see the EMA acting as a dynamic resistance, but it took this all day, even though it spikes, little spikes could scare you out the market. We use a more loose, a wide stop, give the market room to work. Price drops for 109, about 300 pips. I mean, after about 300 pips, it probably would have took some profit. It came back up, same thing, spiked up, rejected. There's another entry, 183. So again, about another 300 pips, 400 pips. This time, now, one other thing I'll show, one little trick I learned around the way is when I see, so I'm following, now I know that I'm in this trend. See, the EMA curving downward, starting to act as dynamic support and resistance. I see price does a pullback. And when price gets, what I start identifying, once we get to this level, I can see, so we're coming off the supply and demand zone, we drop. Then I get right at a previous resistance zone, I get a big candle break. So instead of looking up all the way back up here, now I'm going to be targeting this big candle. I'm gonna see how price reacts at that candle. I remember we were actually in this trade. So price, I think we took the entry here somewhere, 116.80 or something like that. Or we may have been in back here when it broke, but then it kind of wicked heavy. And this huge bullish candle probably faked a lot of people out, but that was I think that was a news candle. But then we come right back with a railroad. So we could have broke down, looked at the way price was moving, and we do have the EMA there as well. So that's going to be supply and demand. Again, if I have people to send in like 2 to 3 charts, put them in a group, work as a team, everybody identify a few of them. Ain't no right or wrong, just see where you would identify your levels. Again, start from the higher time frames, and then your trading time frames will be the lower levels. If you start on the daily, I wouldn't go under two down. You can go 2 or 3. You can go, if you use a daily, go to the hour or the 30 minutes. If you use a 4 hour, go down to the hour, 30 minutes, or 15. I generally like to use the 30-minute for entries. Confirmations is a lot smoother. I don't worry about as much wicks when I see a candlestick on the 30. So everybody good with supply and demand before we shift gears real quick for the last like 10, 15 minutes?
Yep.
Already. So yeah, pretty cool way, cool method, simple, get in and out the market. Next thing we'll look at today is I'm creating next week's or a couple of weeks ahead macro data. What I'm kind of looking at to give me more confidence to hold these trades. So big thing, I'm still eyeing oil, not really any change in oil, no real major growth in demand. So we're still bearish with demand. I mean, no one's really demanding oil or the things that are made from oil, not gases. Gas at the pump, the demand is actually down, and it may be due to the inflation or the higher prices. People are just going where they need to go and getting back to the house. Also the virus, so there's a little scare shutdowns, jet fuel is not going to be as high. This is an example of oil and XPX tends to move together, but oil can, or both of them really can't overshoot or undershoot. The past sell-off has managed undershooting the XPX big time. Let's see if oil can catch a bid. So we'll see if we get a little bit of a push in oil. This was a few days ago, so OPEC came in and they can kind of bully the market. We've seen market dip again. We're back down to 68, 60 something. So for me, this gap does need to fill. Thinking XPX is going to start kind of unraveling a bit. And using my context clues, kind of painting my picture, starting to see signs of that. So this is another thing looking at, so they're all in the realms of trying to identify, we got inflation, deflation, and also direction in the market. So we visited oil. Oil is a good indication of potential of inflation. That's why we're seeing CPI spikes on how we had the energy crisis. There's so much of a narrative of inflation. When we see commodity prices go up, that does show one of the first signs of signal of inflation, because these are the different inputs or things we're going to use to create our products. Whether it's grains, vegetables, they're going to be in a basket of commodities as well. And we'll see that down here. So perhaps not the most important ones, but we worry sometimes China, and this is what the commentary said, China pork prices normalized as herds rebuilt, volatile Indian veggies has fallen. So these are two gauges, and this is more not advanced, but some of these topics are covered in a book that we read in the 3D, but this is getting more in depth with the hundreds of different factors or indicators we can, or let's say different paths that lead us in the same direction, but paths we can take to identify signals or what's going on in the monetary system. So you got the CPI are the percentages of what breaks down into the CPI. We can also see these pork prices, which is an indication of inflation has dropped or ended up being transitory. Even though Powell said we got to quit saying that word.
Bro, I was sick, bro.
Powell said we can't say transitory no more. But yeah, the economy's heating up, but we see that these prices are kind of rolling over. CPI with food down here, it was at 6%. Now it's at about 4%. We got vegetables all the way down, coming up from about 2 to 4% down to -2. As far as its contribution to the CPI, most of this though, you can just see from the hump, most of this is starting to cool off. This next one is kind of giving us example of what are consumers thinking. We were speaking about the Michigan survey data, how consumers have been more worried about the economy. This is Black Friday. It's the first decline in over a decade. People aren't been spending money. 18% of spending at 18% growth since 2015. It's now tracking slightly below the pre-holiday forecast of 109 billion, 111 billion. So we didn't spend as much money this Black Friday or Thanksgiving. Some spending was pulled forward into early November, October, in part reflecting consumer fear out of stocks. So some people could have bought earlier, but it is showing that we didn't get a huge move in consumer spending. Now this is going to be kind of give us some gauges of what we may can expect coming into what we usually see as a Santa Claus rally. Generally from pretty much today till the beginning of the year, the stock market gains strength, the euro gains strength, different risk on. They call it the Santa Claus rally. Now that may be in trouble. We have the tapering. If we look back in history, 2018, they did the similar tapering, and we had like a sharp, like maybe 10% correction during the Christmas rally. So kind of the same setup that we had in 2018, got the tapering coming in. They're speaking about doing it faster. And this is kind of why they're nervous. So you got things like shelter inflation, rents going up across the country. That's going to be what they consider as sticky inflation. You got to think leases are for at least a year, 6 months at the lowest to a year. So these prices will stay elevated for at least, the next year. So they're trying to go ahead and drain out a lot of liquidity. So, everything kind of stable out. So that's kind of why, Trump is big on, he said we can't no longer, he grounded us from saying inflation or it's transitory. This is kind of just going into another view of commodities. We spoke about this the other day with real yields and gold. We see now that they have a divergence in price. So one of these has to follow up. You guys ever remember that when we start getting into comparison? Man, that's 10,000 to 6 figures worth of gain right there. You can always look at some of these to give you leading and lagging indications in the market. You learn which assets or indexes lead and follow. So there's a little bit more about the Tim sent me a message about China earlier, and I had my boy Angelo speaking about the BDI increasing. It's natural for it to kind of increase. I think that's just a natural recorrection or natural retrace. In terms of the US though, we did see slowing or deflationary move inside of a lot of our ISM. The ADP, what was this? ADP payroll increased November after rising 5 cents. So we see the decrease in private or job creation. So less jobs being created, slightly less than 52. The US will cut stimulus faster than the market expects as inflation rise and job market heal. Also, we're seeing slowing global economic, which is historically bullish to USD. So as we see these other countries continue to slow down, China, Euro, with all everything they're going through with COVID, we see these places slow down. They move, generally, everybody moves their money and they float over into the safety of the USD. We also have that variant, despite our personal beliefs on it, still they're shutting down borders, potentially slow down trade. So I sent that in a group with response to the Baltic Dry Index. So we do see that shipping cost is getting less expensive, but China's on the verge of potentially, with the variant, it could slow down exports. It could kind of dwindle within their exports. So even if they are heating up, we see signs of them having increased production or increased orders, which is kind of normal though when I think about it, because coming into the Christmas season, so they're producing more goods. So we should see an uptick, but again, I think that's just a natural retrace after being dropping so heavy. German orders, new orders. So we typically, I'm going to read through all this. We expect this economists expect the euro to fall. We find more compelling macro and flow reasons for a move towards the 110 to be on the horizon. It's just a matter of time. We see euro USD hit our 110. FX is still playing catch up. A global slowdown typically benefits USD. German new orders are in decline and China slowing too. It's difficult to see why European growth should outperform. In addition, there's uncertainty over rising COVID cases, new variants, and restrictions from Numera. So that's coming from Numera. So the rest of this, man, we'll say that for next week. Add a couple more things probably to this. As far as that outcast or that overview of the economy, inflation, still posting that balance sheet. Euro still printing. I think they're printing more money than the US. We'll highlight this again. We spoke about it in previous sessions, but generally when we get commodities, spikes in commodities, you'll see that that's usually leading those spikes a recession in most Eurozones, in Eurozone recessions. So we get a huge crazy spike like that. This little blue area shows where they officially come into a recession. Spike, recession, commodity spike, recession. So Euro's pretty much done for. I'm gonna stick a fork in it and just wait for the cash market, or not cash market, but FX to catch up with what's going on in the macro. So the macro gives us a view into the future, leads the future. So we should see some continuation to the downside of some big moves going in the euro. So German PSI versus ISM's PSIs is down, or no, that's versus ISM new order. So Germany or euro compared to America, it's actually ticking up. Credit impulse for China's down. This again is another leading indication. So China goes down, German PMI orders usually decrease is what they're showing. So we're gonna be looking for their orders of German goods or euro goods to start decreasing as China's credit impulse, or the credit that they have on balance, declines. So all right, man, that's gonna be my little view for the coming up week. So we got anything going on in the market. So JPY kind of strengthened while we've been talking. Things just kind of retrace. See how it moves. Anybody got anything, man, before we jump off? Had a good time today.
I'm good, brother.
No doubt, no doubt.
Kind of babysitting those trades that we're in.
Yeah, man, we're gonna see what it do. It's kind of poking out, man, kind of being mean right now, but we are at that EMA on the hour, and we already got a lot of momentum, so we'll see if it kind of rejects. What time is it? 2 minutes into this. Volume is decreasing a little bit on that 30-minute, hour time frame. A little spike on the 30, but it was less volume than the previous hour candle. So we could roll up a little bit more, maybe test the 20-day by another 10, 15 pips, and then I think we'll go ahead and reject there.
Yeah.
Well, that's CHF, JPY, EJ. Pretty much all gonna do the same thing. You see, they pretty much the same area. There, 20-day a little bit higher. CAD.
That's fucking hilarious.
Hell yeah, you start looking at them like each pair, you just look at shit. Okay, JPY, okay, they all shit. It's the don't, but sometimes they will, some of them be a front runner though. I do gotta add that in. You may have every JPY going down, but for some odd reason, let's say a rate hike in AUD, you see AJ going up because AUD's so strong, but everything else, JPY is going down. Got this here too, though. This is probably an old. But all right, man, we gone, bro. Y'all be cool, man. Stay blessed up.
Peace.
Peace.